Hey, welcome back. In today's video, I'm going to be covering economic data. I'm going to be looking at why economic data is useful for trading and why it matters. And I'll give you my take on the key pieces of economic data that I look at, that I focus on, and I'll give you examples of how economic data moves the markets. Hope you find this useful. Check this out. I want to start off with why economic data matters. So I've got a chart here of the S&P 500, which is a major US index, and I'll be showing you why some of these movements have happened as a result of the general economy falling into recession. So the first example I have is the recession that began in July 1990, which ran for 9 months to March 1991. This was caused by the 1989 savings and loan crisis, leading to hundreds of savings and loans institutions in the US collapsing in the early 1980s to the early 1990s. This also led to high interest rates, and Iraq's invasion of Kuwait also contributed to the recession. What happened here was GDP fell by 3.6% in Q4 1990 and 1.9% in Q1 1991. Unemployment peaked at 7.8%. Now, if you look at the chart, I know you can't really, compared to the other movements, it doesn't look as big, but this was a major collapse in the S&P 500, and that was led by this recession. So just a bit of terminology, a recession is defined as 2 negative quarters of GDP. So that's 2 negative quarters of GDP. So the next collapse we have is in 2001, where the S&P 500 fell sharply. This was led by the 2001 recession that lasted about 8 months from March to November. That was caused by a boom and subsequent bust in the dot-com bubble. So this is where investors poured money into internet startups during the 1990s in the hope that they would become profitable. Many dot-com businesses were significantly overvalued and failed. You also had the 9/11 attacks, which made things worse, with GDP contracting in 2 quarters. Q1 by 1.1% and in Q3 by 1.7%. Unemployment peaked at 6.3%, and you can see the result in the S&P 500. Then we have the more recent example, which was the financial crisis in 2007. So that was the subprime mortgage crisis that triggered a global bank credit crisis in 2007. And by 2008, the damage had spread to the general economy, and GDP shrank in 3 quarters, including an 8.4% drop in Q4 of 2008. Unemployment rose to 10% in October 2009, lagging behind the recession that caused it. And then, of course, more recently, the recession in 2020 that saw the US economy contract by a record 31.4% in the second quarter after falling 5% in the previous quarter. And that was down to the pandemic, which forced businesses to close and people to stay at home. Unemployment skyrocketed to 14.7%. You can see how the S&P reacted, crashing. Now, the reason I wanted to highlight this chart is to show how the stock market, or in this case the S&P 500, and the economy are interconnected. There is good reason to understand the economic data, because what it does is it helps traders, investors, particularly during recessions. It can give you the signal of when to kind of either get out of the way if you're long the market, so you avoid making massive losses, or opportunities to set up short selling. So you may have noticed I mentioned the term GDP quite a lot in the previous chart that we looked at. Now, for those that don't know what GDP is simply the total of all value created in the economy. By value added, I mean the value of goods and services that have been produced minus the value of goods and services needed to produce them. Now, what I've got here is a bar chart of the largest 8 countries in the world by GDP. The data here is provided by the IMF, which includes forecasted GDP for 2021 and 2022. Now, what you'll see is the impact of COVID that's had on GDP across all countries, and you'll see a decline in all countries in GDP with the exception of China. More importantly, if we look at economic data, these are the countries we want to be focused on because these are the largest countries in the world, particularly the US and China. So now that we know which countries to focus on, what data should we be looking at? So here I've pulled out key economic data releases which potentially can move markets, and I'll go through some of these examples in a minute, showing you exactly how one of these data releases moves the market. I'll call out some of the ones I particularly keep an eye on. So the first one I've got here is GDP. So GDP we've already been through, so that's a given and one to watch. If we start with the US, in the US the unemployment figures are released once a month, known as the non-farm payrolls. That's another release I would recommend keeping an eye on, and I'll go through examples of how that impacts the market shortly. Other items to watch out for, so the ISM services and manufacturing PMIs. This is an index representing activity within the services and manufacturing sectors. The key number here is 50, which represents growth versus a decline. So if the reading is 50 or more, that sector is deemed to be growing, expanding. China has its own equivalent of the metric, which is released by Caxin, and a company called Market also publishes these numbers in Europe and the UK, so one to keep an eye on. Then we have CPI. So this is a hot topic right now because it gives an idea of how much the general level of prices are rising. If CPI rises fast, it can lead to GDP growth expanding too quickly, which can lead to asset bubbles and ultimately a concern for a recession beginning. If we then move to China, the trade balance and FDI numbers, FDI being foreign direct investment, are worth keeping an eye on. China is known for manufacturing, so it's a big exporter of goods. The higher the export number, the healthier it suggests the global economy is, because other countries are buying their goods. It means people are spending money and buying goods which have been manufactured in China and exported to other countries. FDI is important because it gives an idea of whether other countries are investing in China. If countries, both corporate and individuals, invest in the second largest country in the world by GDP, that can only be a good thing for the global economy and market sentiment. If we then move to the EU, Germany is the largest economy in the EU, which is also a big manufacturer, particularly of cars. This means traders want to keep an eye out for industrial production activity and factory orders. The stronger these readings are, the more healthier the German economy, which is good for GDP and EU GDP. If we then switch to the UK, consumer confidence and retail sales are both interlinked. If the consumer is confident about the economy, then spending is likely to happen, which in effect lifts retail sales. The UK is a service-driven economy, with consumption, i.e. money spent by consumers, contributing the most to the GDP number. I mentioned the non-farm payrolls report, which comes out once a month in the US. I've got here a 5-minute chart of the Dow Jones on the 7th of May. At precisely 1:30 UK time, look what happens to the Dow Jones. The Dow Jones falls sharply following the release of the non-farm payrolls report. A weaker than expected jobs report is what led to the Dow Jones to sell off. Fewer jobs created hits market sentiment as it suggests the economy is not recovering as quickly as analysts and investors expect. This shows how the market reacts to economic data. At this point in time, you may as well put the technical analysis to one side. Once the data is released, it becomes a knee-jerk reaction to the data. That's all that matters at that point in time. Here's another example. So you've got the euro-dollar chart here reacting to the same headline of the April non-farm payrolls report. This is a 15-minute chart on the 7th of May. Notice how the euro-dollar rallies sharply on the news. This is because the weaker than expected jobs number is a negative for the USD. So the euro is bought against the USD, hence the sharp rise following the announcement. Again, knee-jerk reaction, technicals to one side. That's all the market cares about, that release. So I hope now that we've gone through the concept of why economic data matters, what you should look out for, what data is important, and how it can impact the markets. I hope you can take this away and also take economic data into account with your trading and trading decisions. I've put the economic calendar link, which is available free on my website for anyone to look at, so you can see when the releases happen at what time of the day. Thanks again for watching. Remember to hit that subscribe button if you like the content and you want to see more future videos around trading. Thanks again for watching. Take care, folks.